Hey everyone, today I want to talk about something that's been bugging me, and probably should bug you too if you're invested in the S&P 500. We all know the S&P used to be the gold standard for broad market exposure, but it's getting less broad by the day. It's becoming a one-way ticket to Big Tech Central, and that scares me. To give you some context, I've been hearing from people like Chip Rewey, CIO at Rewey Asset Management, who's been ringing the alarm bell on this. Chip's point is pretty simple.
Look, the Mag 7 as a group is about 30 to 32% of the S&P 500. In general, I think it's kind of overvalued, and I don't think it provides diversification when you look at it from an ETF standpoint.
When 1/3 of your index is just 7 names, you're not really diversified. You're just massively overweight whichever way those giants move. Think about it. If any one of those 7 companies hits a rough patch, regulatory headaches, supply chain disruptions, or even just a market rotation away from growth, you feel it in your portfolio. It's like betting on a handful of horses and calling it a horse race. Meanwhile, sectors like financials, industrials, and consumer staples barely register. Here's another insight from Chip that really stuck with me.
What is the market? Is the market the Dow? Well, no. Is it the S&P 500, which is dominated by 7 stocks for 32% of its weighting? Well, not really. What is the market? And
you own a concentrated portfolio of stocks. And that's the crux of the problem. Most people who buy the S&P think they're getting a slice of the whole economy, but they're really buying a tech-heavy, AI-heavy bet on a few winners. So what's the alternative? Chip suggests looking outside that Mag 7 bubble. Smaller cap stocks, mid-caps, underfollowed names, they tend to offer more value and true diversification. As you go down cap, you see a lot of undervaluation. You see a lot of neglect, he says. That neglect can be your opportunity. You do your homework and pick names with solid balance sheets and growth prospects. And don't just assume every ETF or index fund will save you from concentration risk. Many of them simply mirror the same big cap weights. If you truly want to spread your bets, it might mean building your own portfolio, mixing in some regional banks, parts of the energy sector, even defensively oriented utilities or staples that have been overshadowed. At the end of the day, the message is clear. The S&P 500 isn't as diversified as it once was. When a handful of companies can move the entire index, it's worth asking yourself if you're comfortable with that level of concentration. If not, it might be time to look beyond the usual suspects and craft a portfolio you can really believe in. Or if you still want to stick to your ETF buying mentality, buy the total market. Something like VTI. Along with some international or emerging market ETFs, plus bonds, plus gold, plus a bit crypto, and even real estate via something VNQ. Plus subscribe to this channel. Plus like and comment on this video and share it with your investor buddies, and I'll see you in another one.